Today we are going to talk about the Federal Reserve, the basis point hike, and how that's going to impact us, and also a couple of bets that we can make to hedge against both the rate hike and inflation. My name is Mike Perna, local real estate agent here in Metro Detroit, and if you're considering buying or selling a home, we would be honored to serve you and your family. So the Federal Reserve just raised interest rates by another 75 basis points, which means we are officially sitting at the highest interest rates that we've seen early 2018, marking the end of an era where money was as close to free as it has ever been. And now we're entering a new era of investing that most people just haven't seen in their lifetime. A lot of our millennials and Gen Z friends. So let's talk about which of your investments are most likely to be affected and how you can use this information to make you money, especially when the Fed has just completely flipped the market. Although before we get going, please hit that like button and subscribe to the YouTube so that when we have more videos drop, you'll be notified. So a little bit of background info. Through 2022 so far, the Fed has consistently raised interest rates in an effort to combat inflation. And the thought process here is it's going to slow people purchasing and borrowing, which is going to slow prices because there's going to be less demand and a lot of supply, trying to get that back down to the safe and stable 1 to 3% inflation rates per year that we have consistently seen over the last 30 years, give or take. So right now, inflation has been taking down people's purchasing power faster than wages have grown, and that's a huge problem. Right now, we have wage growth at 5.5% and inflation's hitting 9.1%. That's exactly what's happening, and the longer we go down this road, the more rate increases we're likely to see. So as that happens, we need to have the conversation to be sure you're in the best financial position as possible. To start with, let's talk about the part of our economy that's going to be hit the hardest by highest interest rates, which is going to be the real estate market. At the beginning of the year, interest rates were literally 2.75% on a 30-year fix, and they have raised to 5.75, literally over double as of right now. We are sitting at the highest interest rate since 2009, and to put it into a more tangible perspective, if you got a loan, a mortgage for $300,000 in January, that would have cost you $1,265 a month at a 3% interest rate. But today, that exact same loan is going to cost you $1,700 a month at a minimum at a 5% interest rate. And if your interest rates continue to go up at a 7% interest rate, that's now going to cost you $1,996 a month. And at 8%, I don't even want to get to 8%, but at 8%, we are doubling up to over $2,000 per month. Literally, the monthly cost of a mortgage has raised by 50% from January to today, and several economists are now projecting that home values are not going to continue to rise, or at least not as fast as they have, but instead are going to stall out. Further, move-up buyers, people that have outgrown their current home, while they have great equity to put down on the next home, looking at the average second-time homeowner's loan being about twice as much as their current loan and the money being twice as much to borrow as far as the cost goes, many of them are now looking at the 4x payment of what their current payment is, and they are opting out of the real estate market. This is actually more of a positive because as first-time home buyers are getting priced out of the market and they're withdrawing themselves, first-time homes themselves are opting out of the market as people are deciding to stay put instead of upsize. Now, it is nearly impossible to predict how anything is going to react as far as interest rates versus real estate versus the stock market, but prices tend to trend to continue upwards. So if you're a buyer, this shouldn't change anything or completely derail your plans. And in the future, you can always refi at a lower rate to take advantage of the lower interest rates when those come in 2023 and 2024. Now, the second big disruption is going to happen with the stock market. When it comes to interest rates, there's no shortage of charts and graphs out there showing that the stock prices took off the moment the interest rates started to decline during the pandemic, drawing the conclusion that the opposite must also be true, that if interest rates go up on the most basic level, stocks have to crash. Since the 1960s, even throughout rate increases and decreases, the stock market has continued to trend higher and higher and higher. And if we take a closer look, most recently in 2017, we can see that throughout several rate hikes, the market defied the odds and kept going up overall. It's assumed that as long as the Federal Reserve slowly and effectively communicates their intentions to the market so that everybody doesn't panic, rising interest rates should not be a complete disaster. This last 75 basis point is a great example. The announcement was made in the afternoon and the stocks did not tumble like previously, they actually rose that day. And in fact, markets have started to recover over the past 60 days, including the S&P 500, the Russell 5000, and even crypto is starting to come back to life just a little bit. As well, streaming services like Netflix are also on the discretionary list and largely starting to get cut. Families are starting to share their passwords and cancel their individual subscriptions, and I'll be the first to admit that I share mine with my parents, so that's one less subscription they have to pay for, and that's happening all over the country. country, I promise. Now, a recession is defined as 2 consecutive quarters of declining GDP, gross domestic product, but most experts say that we have less than a 50% chance of confirming an actual recession in the next 12 months, that these bumps in the roads are going to even out. And one thing we know is as soon as the inflation comes under control, the Fed is going to start dropping interest rates like a rock off a bridge, making a big splash in the real estate market and the stock market. Now let's talk about some of the winners in a recession or a downturn. Number one are going to be the low-risk savers, people that like CDs, money market accounts, and bonds. For the last 2 years, you've probably noticed that most high-interest savings accounts were not paying you actually pretty much any interest at all. But now that the Federal Reserve has begun to raise rates, savings accounts are actually paying you a healthy amount, like the good old days when Ally Bank used to pay above 2%. Actually, at one point they paid 3%. And a savings account could outperform the stock market in years where the stock market has remained relatively flat. At least you're earning that interest. All right, so let's get on to the top 5 banks that are paying a great amount of interest. They are FDIC insured, and they'll probably go a little bit higher as the rate hikes are coming up. First, we've got Ally Bank. Right now, they're offering a 1.25% interest rate with their completely free savings account. Now, the downside of their checking account is the checks have to be a minimum of $250 per check or per withdrawal. So keeping money here and paying bigger bills like mortgages is a good use of this account. Next up, we've got Marcus by Goldman Sachs. This is another completely free savings account that pays you 1.2% as of the shooting of this video. And they've got some really great reviews, which I appreciate. Third, we've got SoFi, who's currently offering 1.5%, and they'll give you up to $300 when you sign up and set up direct deposit. Fourth, we've got Citibank. It's one of the highest at 1.65%. And fifth and last, who's paying the most is Citizens Bank at 1.75% as of this taping. Even though this is not a bank I've ever had experience with, it seems like a great overall option. So while you're not at least matching the inflation rate and you are going into a deficit, you're at least not getting paid like a 0.01%, which may as well just be zero. So next up on our list of winners in this market are going to be people with fixed rate mortgages or with adjustable rate mortgages that are at least 3 years, preferably 5 years out. Now, anyone with a 1-year ARM that's getting ready to reset, brace yourself. That payment is about to go up substantially, and you may as well start cutting household costs now in anticipation of it. Now, as long as you locked your interest rate in and you've got a fixed rate mortgage, it's not going to be impacted by the Federal Reserve's decision, so your payment stays exactly the same. If you bought a home and you had a 3% payment, that's going to remain at a 3% payment. If you have a 3 or a 5-year ARM coming up, it might be a great time now to look at fixing into a locked rate loan, and then you're insulated whatever happens in the future. And if interest rates go down, you can always refinance. Call me if you have questions about which direction to go in, and together we can weigh the pros and the cons of each of the 4 main loan products available currently. And be sure you're setting up your family for financial success. And finally, long term, the inflation rate, I believe, is starting to get back on track. It's not looking great, but it's at least looking better than it was last month. Looking at the gas pump alone in the last 30 days, prices have come down 60 cents a gallon on average. Now, I'm not saying gas prices are great. They actually really suck. But it's not as bad as it was 30 days ago. And in fact, Jerome Powell had a lot to say about this in terms of the future outlook and where they were thinking they were going to take rates in the future. They did do a 0.75% rate hike instead of what the anticipated 1% could have been, indicating that he thinks that inflation is starting to soften a little bit and we can start to see the reversal of sky-high consumer prices before the end of the year. While I don't think this is going to be the end of rate hikes, it is marking the end of major rate hikes we're going to see in the balance of 2022. We'll have to wait for 2023 to see where inflation is, to see if we're going to continue raising those rates or come down. Any way you cut it, the next Fed meeting doesn't happen until September, so we're going to have to wait till then to see what goes on next with rates. But the good news is we've got 2 inflation reports that will hopefully see this start coming down between now and September, and if so, Powell will probably hold rates and not raise them for fear of a recession. So I'm going to end the video with this. I'm going to give you the same advice that I give my family and my friends, and I myself make use of. Save a minimum of 15% of your gross income. Now, first max out your retirement accounts, whether it's a 401k, an SEP, or a Roth IRA. Second, if you can move that number up to 25%, do it immediately. Hedge your bets, lower family costs. Third, one thing we do know is that over time, both real estate and stocks always go up in value 100% of the time. Clearly, I'm not talking about individual stocks like Blockbuster or Kodak, which over a long enough period of time always go to a zero value, but in fact the opposite. The index funds like the S&P 500 and the Russell 5000 over any 10-year period go up 100% of the time. Check out the book Psychology of Money by Morgan Housel for a lot more on this. Now, I'm going to leave you with a fun fact, and all that I'm going to ask for is hitting the like button and the subscribe button. Did you do it? Did you hit it? On with the fact. If Warren Buffett invested $10,000 when he was 16 years old into an S&P 500 fund, when he turned 76, he would have $52 million in that bank account, as long as he didn't touch it, which is the true Achilles heel of every investor, wanting to move the money around and go and touch it and pull it out and put it back in. My name is Mike Perna. I hope you found this information helpful about the future outlook of both inflation and the interest rates. Should you have a need to purchase a home or sell a home in the future, please don't hesitate to reach out anytime at 248-886-4450, and I'll catch you on the next video.